Hello viewers. Welcome to our deep dive into the world of financial risk. Today, we will explore what risk means in finance, the different kinds of risks, how to measure them, and most importantly, how to manage them. To understand financial risk, let's start with the basic definition. Risk in finance refers to the uncertainty regarding the future outcomes of financial decisions. Now, to truly grasp risk, it's essential to know the types of financial risks. The most common ones include market risk, credit risk, liquidity risk, and operational risk. Let's break these down with examples. Market risk is the risk of losses due to changes in market prices. For instance, a stock you invested in could drop in value. Next, credit risk is the risk that a borrower will default on a loan. For example, if you lend money to a friend and they can't pay you back, you've encountered credit risk. Liquidity risk is the risk that an individual or firm will not be able to meet short-term financial obligations because they can't easily convert assets into cash without a loss. Finally, operational risk stems from the day-to-day operations of a business. For example, a cybersecurity breach can lead to significant financial losses. Now that we know the types of risks, let's discuss how to measure risk. The most common metric is standard deviation, which measures the volatility of returns. Standard deviation can be calculated using the following formula. The standard deviation is the square root of the variance. To visualize this, here's a graph displaying the standard deviations of different investments. As you can see, investment 2 has the highest volatility. Now, let's move on to some examples. Imagine you have two investment options. Investment A returns an average of 8% a year with a 5% standard deviation, while Investment B returns an average 6% a year with a 2% standard deviation. Which one would you choose? Investment A has a higher return, but also comes with higher volatility. Investment B is safer, but has a lower return. It boils down to your risk tolerance. Now, let's address some common questions about financial risk. Question: how can you manage financial risk? Answer: diversification is key. By spreading your investments across different assets, you can reduce the impact of any single asset's poor performance. Question: what is risk-adjusted return? Answer: it's the measure of return on investment taking into account the risk involved. Common metrics include the Sharpe ratio and the Sortino ratio. Question: what is beta? Answer: beta measures the volatility of an asset relative to the overall market. A beta greater than 1 indicates higher volatility, while a beta less than 1 indicates lower volatility. With a firm understanding of risk, let's conclude. Remember, understanding and managing risk is crucial for successful investing. You don't necessarily have to eliminate all risk, but you do need to be aware of it and take steps to manage it effectively. Thank you for joining us in this comprehensive guide on financial risk. We hope you found it informative. Don't forget to like, comment, and subscribe for more finance video tutorials. See you next time.